Welcome to the Practicals of Livestock Economics and Business Management. We'll begin with bookkeeping. Bookkeeping is the recording of financial transactions in the form of purchases, sales, receipts, or payments in a business or enterprise. Bookkeeping is actually a part of the process of accounting. Now, many of you may be thinking that how is bookkeeping different from accounting? And isn't bookkeeping the same as record keeping? Bookkeeping is not the same as accounting, and certainly not the same as record keeping. Whereas bookkeeping is the recording of financial transactions, accounting deals with analyzing the records and processing the information and communicating the same. Simply stated, accounting deals with analyzing the financial records to calculate profit, loss, and liabilities, etc. Moving on to bookkeeping and record keeping. Record keeping deals with maintaining an account of activities, events, and materials regarding the business operations. Whereas bookkeeping is limited to financial transactions alone, record keeping can cover financial as well as other aspects. For example, in a dairy farm, various records are maintained such as daily production of milk, feed consumed by animals, or labor present. These records are not financial records. However, sale of milk, purchase of feed, etc. are financial records. We move on to the features of bookkeeping. Bookkeeping deals only with financial records. Daily recording of business transactions is mandatory. The exercise of bookkeeping is for a specific period of time, usually 1 year. Let's talk about the types of bookkeeping. Two types of bookkeeping are most commonly used. The first is single row and the second is double row. We'll be discussing about it in detail in the coming presentations. We'll conclude the discussion with importance of bookkeeping. Bookkeeping is a systematic and permanent record of all the transactions. One can refer back to the books of accounts for information regarding transactions made in the past. Secondly, bookkeeping is used to get information on profit, loss, assets, and liabilities of a business, or in the case of animal husbandry, the animal farm. As we have already discussed, bookkeeping is the primary step in accounting. Bookkeeping makes it easy to control the activities in a business. It means that the entrepreneur is always informed on the transactions taking place every day. Then bookkeeping serves as an evidence in case of any disputes. And finally, it helps to calculate tax liabilities of an enterprise. With this, we end our discussion.
In this section, we will be dealing with rules of debit and credit. Rules of debit and credit depends on the nature of transaction related to a particular account. So, we need to understand the various types of accounts related to accounting. So, on your screen you can see there are majorly two types of accounts. First one is personal or bank account. These are the accounts relating to a person or organization. Then the second one is impersonal account. These accounts can be further categorized into real accounts and nominal accounts. Real accounts. These are the accounts related to various assets like land, building, machinery, cash, livestock, etc. The nominal accounts. These are the accounts of income, expenses, gain, losses, example wages, rent, discount, insurances, etc. You can see the various rules regarding these accounts. As far as the personal accounts are concerned, so you should debit the receiver or customer, then you should credit the giver or supplier. Then as far as the real accounts are concerned, so what comes in, you should debit it, means you should debit what comes in and you should credit what goes out. The nominal accounts are concerned, all expenses or losses should be on the debit side and all income, gains or profit should be on the credit side. How to identify various accounts? Now it is very important to identify the nature of accounts associated with various transactions. An example is given for your reference: purchase machinery for cash rupees 5 lakh. So in this case, you need to identify the various accounts involved. In this particular example, machinery comes under the category of real account, So as per the rules of real account, debit what comes in and credit what goes out. Here is another example. Paid salary by cash rupees 5,000. So in this case, you need to identify the various types of accounts associated. So salary is a nominal account and cash is a real account. So cash comes under real account category and salary comes under nominal account category. So as per the rules of these accounts, cash is going out, so credit the cash, and salary is an expense, so all expenses or losses should be debited, so debit the salary. So likewise, sold furniture for cash rupees 35,000. So same is the case, furniture is a real account and cash is also a real account, so you can debit the cash and credit the furniture. Then received fee by cash rupees 7,000. So you need to identify the accounts. Fee is a nominal account and cash is a real account, so you must debit the cash and credit the fee. So goods sold to Singh for rupees 5,000. In this example, goods are real accounts and Singh is a personal account, so you should write Singh or the transactions related to Singh account on the debit side and transactions related to goods on the credit side. So this is all regarding the rules of debit and credit. So in this section, we will be learning about making journal entries. So journal entries are very important if we want to write ledger and cash book. We need to understand the methods of entries so as to ease our accounting. What is a journal? It is a record of financial transactions in order by order. A journal is a detailed account that record all the financial transactions of a business. So that should be used for the future purpose. Journal is also called as a book of original entries. It provides date-wise record of all transactions, means so transactions related to debit and credit. Then various steps regarding journalizing. It is very essential to analyze a transaction in order to determine the affected accounts. It is not necessary to use the word account or AC after personal accounts. The words like being or for are used before starting to write down a narration. After every journal entry, a line should be drawn in particular column so that each entry is separated from the preceding one. At the end of each page, both the debit and credit columns are totaled just in front of each other and these must be equal. The words like carry forward are written in particular column at the end of each page and the word like brought forward is written at the start of next page. So in this case, we need to identify the accounts associated with the entries. So likewise, we have studied the different types of accounts like personal, impersonal, real and nominal. So the rules are same. Then pro forma of journal. So on your screen you can see the pro forma of a set journal. So first column is of date. In this first column, date of transaction is entered and the year/months is written only once till they change. Means you need not to change the date or month unless and until they change. The sequence is maintained very strictly. Then the second column is of particulars. Each transaction affects two accounts, out of which one account is debited and other is credited. Account to be debited is written first and DR is also written towards the end. Accounts to be credited should start with word to in the second line. There is no need to write word CR in the end. Narration: a brief explanation of transaction together with necessary details. Word like being or for should be used before narration. Ledger folio. All entries from journal are later posted into the ledger account. Folio/page number of ledger where the entries has been made is recorded here. Amount debited. The amount of the account being debited is written. Amount credited. The amount of the account being credited is written. Then how to make journal entries. On the screen there are two types of questions related to transactions. First of all, we need to identify the accounts associated with these transactions and then apply rules of journal entries. So the first question is, on June 1st, Ravi started business with cash rupees 50,000. So we need to identify the accounts related to these transactions. So as per rule, cash is a real account and cash is coming in, means debit what comes in, and Ravi is a personal account and Ravi is the giver of cash, so credit the giver. So on your screen you can see the transaction and you must write June 1st in the date column. Then in the column of particulars you must write cash account debited to capital account, and in the narration you can write being business started by cash. Then in the ledger folio you need not to write anything right now because you haven't made any ledger. So if you have made any ledger, then you can write the ledger folio here. Then amount debited you must write 50,000, and then amount credited you must write 50,000. Then the second question, on June 1st cash deposit into bank rupees 30,000. So you must identify the accounts related to these transactions. First account is bank, that is a personal account, and bank is the receiver of cash, so you must debit the receiver. Then cash account, cash is a real account and cash is going out, so credit what goes out. So you can see on the particular column bank account debited to cash account, and in the narration you can write being cash deposited into bank. So you can write 30,000 in front of debit and 30,000 in front of credit. Then in third example, June 3rd purchase good worth rupees 1500 and paid by check. So here you can see there is no cash associated with this transaction, so we must identify the various accounts. The goods belong to real account, so goods are coming in, debit what comes in, and check means bank is paying that cash. So check oblique bank is a personal account and bank is the giver of cash, so credit the giver. So you can write purchase account debited to bank account. Against the purchase account debited you can write 1500, and against to bank account you can write 1500. In the narration you can write being purchased goods and paid by check. So in this case you need to change the date because date is changing. Then in the fourth example you can see June 3rd purchase office equipments for rupees 20,000. So you need to identify the accounts. As per the rules, equipments are in the category of real accounts and equipments are coming in, so debit what comes in, and cash is a real account, cash is going out, so credit what goes out. So you can write in the particular column you can see office equipments account debited rupees 20,000 to cash account rupees 20,000. So in the narration you can write being purchase office equipments by cash. There is another entry on June 9th, sold goods to Inder rupees 8,000. So as per the rules, goods relate to real account and goods are going out, credit what goes out, and Inder is a personal account, so Inder is the receiver of goods, so debit the receiver. So you can see the various transactions related to these entries. In this section we'll learn about making ledger entries. So first of all, what is a ledger? It contains classified and permanent records of all the transactions of a business. A ledger is a book which contains all the accounts of business enterprises, whether personal, real or nominal. After journal entries are made on the ledger in their respective accounts, each account in a ledger is opened on a separate page or card. It provides date-wise record of all transactions like debit and credit. A ledger is also called as principal book or book of final entries, as the transactions that are entered on the journal are usually incorporated into the ledger. So entries of transactions on a ledger are quite different, and in the case of ledger you need separate ledger books for various accounts. For example, on your screen you can see, so this is the same transaction that we entered on the journal. For this transaction you need to find out different type of ledger associated with it. In this particular case there are two types of ledgers associated with it. First is cash ledger and the second one is capital ledger. So the entry is June 1st Ravi started business with cash rupees 50,000. So in journal we have made these entries like cash account debit rupees 50,000 to capital account 50,000. So how you can make entries on a ledger? So the rules are, for debit side entries, write its credit part on the debit side, and for credit side entries, write its debit part on the credit side. It's so simple. If you are posting on the debit side entry, then always start with to, the word to. If you are posting on the credit side entry, always start with by. So in this case, so you can see in example, cash account debited. So it means you need to write that cash entry on the debit side. But what you have to write? You have to write to capital account 50,000. Because this is a cash ledger, you need not to write the entry regarding cash. So you need to write entry regarding the capital. For this entry, you need another ledger, that is capital ledger. For the same transaction, like June 1st, Ravi started business with cash rupees 50,000. So for this capital ledger, the rules are same. For debit side entry, write its credit part on the debit side, and for credit side entries, write its debit part on the credit side. If you are posting on the debit side, so start with to, and if you are posting on the credit side, start with by. So the entries would be like date June 1st, and particulars you need to write by cash account, and then in the amount column you need to write 50,000. Then there is another example. On June 1st, cash deposit into bank rupees 30,000. So this is the example we have mentioned in the journal practical. So for this transaction, bank account debited rupees 30,000 to cash account 30,000. So rules are same. So you need to write in the particular column by bank account amount 30,000. So there is another example. June 1st, cash deposit into bank rupees 30,000. So this is the same example on which we have made entries in the cash ledger. Then we need to make another ledger, that is bank ledger. So for bank ledger, you need to write the entries on the debit side, because so you have to write entries regarding the cash. So the rules are same. So in the date column, you have to write June 1, and in particulars you have to write to cash account. So in the account column you have to write 30,000. So likewise you can make as many as entries you can, and you can make bank ledger, cash ledger, and various other ledgers associated with different types of accounting and transactions. So how to calculate and total balance in ledger? It is very important aspect. At the end of month or at the end of every month, every account should be closed with carried down if the balance is remaining. Means if you have any remaining balance, you have to write carried down in front of the balance, and you have to start the next month. Means in the beginning of next month, every account should be opened with brought down balance. Means if you have balance in the previous month, then you have to start the next month with the same balance. So here is an example on the screen how to calculate and total balance in ledger. So this is the cash ledger for which we were making entries. So you have to calculate the total amount on the debit side. So as I have calculated 50,000, 20,000, 3,500, so the total is 73,500. And on the credit side, so the total is 36,000. The difference is 37,500. So if there is any difference between the debit and the credit side, then you must write balance carried down, C/D, and then you have to start the next month with the balance brought down. So you have to write the same balance. Likewise, I have written 37,500, and then you have to start the next month as I have started July 1st with balance brought down 37,500. So for example, in this case, debit side was having the highest total. The highest total is 73,500, and the credit side was having the lowest total, means 36,000. So whenever you are starting the next month, you must start with the debit side. You must write that brought down balance on the debit side. So these are the rules regarding making entries on the ledger. So various advantages of ledger: all accounts on a separate sheet means so you can put all accounts on separate sheets, easy access to information like debits, credits, purchases, sales, amount paid or received. Profit and losses accounts can be defined by ledger balance, and then balance sheet can be prepared with the help of ledger.
This section is about cash book. A cash book is a book in which all transactions relating to cash receipts and cash payments in a given period of time are recorded. A cash book is also called the book of original entry and final entry. A cash book is used to record only cash transactions. A cash book essentially has two equal sides: the left hand side called the debit side and the right hand side called as the credit side. While recording cash transactions, cash receipts or the incoming cash is recorded on the debit side and the cash payments or the outgoing cash is recorded on the credit side. The difference between the total of debit, that is incoming, and credit, that is outgoing, is the cash in hand. Cash book always shows debit balance. It means that one cannot pay more in cash than the cash he receives. Types of cash book. There are two main types of cash book. The first is main cash book and the second is petty cash book. Main cash book has three further categories. The first is single column cash book, the second is two column cash book, and the third is three column cash book. A single column cash book has two equal sides, the debit side and the credit side. In each side, there will be different columns like date, particulars of transaction, ledger folio, and amount. A single column cash book will be used only for cash transactions. The entries in debit side of the cash book are recorded as credit in the corresponding account of ledger and vice versa. Let's look at an example. A businessman has cash in hand of rupees 6,500 on April 1. So how do we record it? We record this transaction or we record this amount on the left hand side. We start with the year of the transaction followed by the date, that is April 1. Under the particulars column, we'll write balance brought down. Under the column of ledger folio, we can record the entries that are made in the corresponding account of the ledger. Under the amount section, we'll write 6,500 rupees. On April 3, he purchased goods for cash of rupees 685. This means that the cash is going out. So we'll record this transaction on the right hand side. On April 6, he deposited an amount of rupees 2,000 in the bank. So we record this transaction on the right hand side. On April 15, he sells goods for a cash of rupees 2,500. So we record this transaction on the left hand side. Now at the end of the month, we'll total the amount under the debit section, that is rupees 6,500 plus rupees 2,500. The total amount is rupees 9,000. Similarly, we'll add the amount in the credit section, that is rupees 685 plus rupees 2,000, and we'll minus this amount from the total on the debit side, and the amount that remains is rupees 6,315. So we'll record this balance on April 30 as rupees 6,315. This amount will be carried forward to the next month. And under the next entry, year 2021, date May 1, we'll enter this amount on the debit side. Balance brought down 6,315 rupees. Moving on to the two column cash book. Whereas the single column cash book had a single column for entering the amount of transaction, there are two different columns for entering the amount of transaction in a two-column cash book. Most commonly, a two-column cash book is used to record two entries, that is cash and discount. So we'll have both of these columns on the debit side as well as the credit side. Let's look at an example. On September 1, the businessman had balance in hand of rupees 2,500. So we'll record this on the left hand side, that is the debit side. On September 5, he purchased furniture for cash rupees 750. This amount is going out, so we'll record this transaction on the right hand side. On September 7, he received a cash of rupees 980 from Verma & Company, and he allowed a discount of rupees 20 on the payment. So we'll record this transaction on the left hand side. The discount will be mentioned under the discount column, and the amount received will be entered under the cash column. On September 10, he paid an amount of rupees 290 to someone called Bihari, and that person allowed a discount of rupees 10 on the transaction. Since this amount is being paid, we'll record it on the right hand side. Now, similar to the single entry cash book, we'll add up the amount under the discount column and cash column on the left hand side, that is the debit side. The amount comes up to be rupees 20 and rupees 3,480 respectively. We'll use this amount of cash on the debit side to calculate the balance on the right hand side, which means subtract the total of 750 plus rupees 290 from rupees 3,480. The balance amount comes to be rupees 2,440. So this balance amount will be recorded on September 30, and the same amount will be carried to the next month. A 3-column cash book has 3 different columns for entering the amount of transaction: the discount column, the cash column, and the bank column. And each of these columns will be present on the debit side as well as the credit side, apart from the usual columns such as date, particulars, and ledger folio. An important concept in 3-column cash book is that of contra entry or the double entry. You must remember that while entering transactions related to the deposition of cash to bank or the withdrawal of amount from bank for office use will be entered as a contra entry. It means that this entry will be made on the debit side as well as the credit side. So here's an example. On April 1, the businessman had cash in hand of rupees 9,000 and the amount in bank was rupees 3,000. So we record these entries on the left hand side. He made sales and received a check of rupees 1,270. So this amount will be coming into the bank account, and we'll enter this amount under the bank column on the debit side. On April 8, he purchased furniture for rupees 900 and received a discount of rupees 100. So this amount is going out, and we'll record this on the credit side. On April 20, he made purchases for cash and issued a check of rupees 2,500. This means that the amount is going out from the bank account. We'll make this entry on the right hand side. On April 25, he deposited rupees 4,000 into bank. This is a contra entry. He is making a deposit from the cash, that is rupees 4,000, and this amount is going into bank. Now, on the left hand side, we'll enter this as cash account and we'll make this entry under the bank column, which means the amount is being received into the bank account. And corresponding to that, we'll make a double entry on the credit side. The second type of cash book is a petty cash book. Now, at the farm level, small payments are made routinely, and these payments are not recorded in the main books because it's tedious to record these small amounts of money. A small fund is obtained from the main cashier for meeting such expenses, and it is recorded on the left hand side of the petty cash book. The expenses made are recorded on the right hand side. When the fund amount declines, fresh cash, which is equal to the expenses incurred during the month, that amount is obtained to raise the fund to the original amount which we had at the starting of that month. So let's look at an example. The petty cashier received Rs 2000 on May 1 from the head cashier, and for the month, the details of the petty expenses are listed on the screen. On May 2, the expenses were Rs 55 to pay for auto fare. On May 4, postal stamps were purchased for Rs 105. On May 20, the petty cashier purchased erasers, sharpeners, pencils, and writing pads for Rs 225, and on May 26, he paid Rs 98 for Xerox. We'll begin the entries with the year, that is 2021, and then the month, that is May. The amount received from the head cashier, that is Rs 2000, will be recorded on the left hand side. And then under each date, the expenses will be entered. On May 1, cash received was Rs 2000, which was recorded on the left hand side. On May 2, he paid Rs 55 for auto fare. Under the particulars section, we'll enter auto fare. Under the amount paid, we'll add amount of Rs 55. And similarly, under the conveyance, we'll add Rs 55. Similarly, we'll be making entries for postal purchases, stationery, and Xerox copies. At the end of the month, we'll be adding up this amount under the amount paid column. This amount must be equal to the total of amount under each of the columns to the right hand side. We'll be subtracting this amount, which is Rs 483, from the main amount of Rs 2000, and the balance comes to be Rs 1517 on May 31. That is the last date of the month. The total of the balance amount and the expenses made comes to be Rs 2000. So we have a balance. Then under the next month, we'll be entering the balance amount from the previous month, that is Rs 1517, and also will be making another entry of the amount received from the main cashier, which is equal to the expenses of the previous month, that is Rs 483. So that's it for this discussion. Thank you.
Preparation of trading account. Trading account is a good account prepared to know the profitability of the goods bought and sold by the businessman. It is an account that shows the gross profit or gross loss, which is the result of trading, that is buying and selling. The difference between the selling price and cost price of goods is gross earning. The gross earning or gross profit dictates the terms of the business, that is whether the trader should continue to trade in the same line of goods or to change over to the different type of goods. However, when the cost of buying is more than the selling price, the result is gross loss. The format of trading account. First of all, there is name of the business or proprietor, the trading account for the period ended. On the left hand side, this is the debit side indicated as DR, and on the right side it is credit side indicated as CR. The word to is used before entry of any item on the DR side. The word by is used before the entry of any item on CR side. Now, what are the different items in a trading account? First of all, on the debit side, the first item to be posted is opening stock. The stock of goods remaining unsold at the end of last year is termed as opening stock of the current year. The opening stock includes opening stock of raw materials, semi-finished goods, and finished goods. Last year closing stock is current year opening stock. Current year closing stock will be next year opening stock. Next item on the debit side is purchase and purchase returns. Goods which have been bought for resale, both cash as well as credit, are termed as purchases. The goods which are returned to the suppliers are termed as purchase return or return outwards. The purchase return will be shown as a deduction from purchases on the debit side of the trading account. Third thing on the debit side is direct expenses. All the expenses incurred in the purchase of the goods, bringing them to the godown and manufacture of goods are called direct expenses. It includes wages, carriage, manufacturing expenses, dock charges, import duty, excise duty, octroi, and royalty. Now the items on the credit side. First thing is sales and sale returns. Both cash and credit sales will be included in sales. Sale returns are the total amount of goods returned by the customers. Sale returns will be deducted out of the sales and net sale is shown on the credit side of the trading account. Second thing on the credit side is closing stock. The goods remaining unsold at the end of year is known as the closing stock. It is valued at cost price or market price, whichever is less. It includes the closing stock of raw material, closing stock of semi-finished goods, and closing stocks of finished goods. Third thing posted on the credit side is good damaged or lost or destroyed or consumed personally. If the credit side exceeds the debit side, there will be gross profit. It is entered on the debit side of trading account. However, if DR side exceeds the CR side, there will be gross loss. It will be entered on the credit side of trading account. The gross profit is transferred to the CR side of profit and loss account, and the gross loss is transferred to the DR side of profit and loss account. Now about the importance of trading account. It provides information about gross profit and gross loss, so a trader can ascertain the percentage of profit he has earned on the cost of goods sold. This percentage of gross profit may serve as his ready guide for the adjustment of the future sale price. Second importance is a trading account helps a trader to compare his stock at open with that at the close. He can further find out whether the purchases he has made during the period of account have been judicious. Third, one can compare the figure of sales with same figure of the previous year and can find out whether business is improving or declining. Fourth, if the gross profit disclosed by the trading account is less than expected, an inquiry can be made to find out the cause responsible for the decline. And if the gross profit is more than was expected, steps can be taken to maintain it. Fifth importance is it provides information about the direct expenses. Now let us understand the trading account with the help of an example. Prepare a trading account for Mr. Yogesh and Company for the financial year ending March 2021 from the following information. The information given is opening stock, purchase, manufacturing expenses, sale, purchase return, dock charges, sale return, and the closing stock. This is the format of the present problem. The trading account of Mr. Yogesh and Company for the year ending 31st March 2021, and on the debit side we post opening stock, purchase, The purchase returns are debited from the purchase and the net purchases are calculated. And on the debit side, next item is manufacturing expenses and the dock charges. While on the credit or CR side, we post buy sale and the sale returns are deducted from the sale and the net sale is calculated. And we also post closing stock on the CR side. Now we make the total of the CR side. It is 19,000 plus 8,000 equal to 27,000. While on the DR side, the total is 10,000 plus 8,000 plus 1,500 plus 500. Total is 20,000. In the present problem, the CR side is more than the DR side. The higher figure, that is 27,000, is posted at the end of the account on both DR side and the CR side. The difference between the CR side, that is 27,000, and between the DR side, that is 20,000, is the gross profit, that is 7,000. It is posted on the DR side.
The livestock farmer who is especially doing or running its farm on the commercial basis is very much interested to find out at the end of the financial year that what I have gained and what I have lost, and it can be termed as a income statement. So first is the assessment of net profit and net loss at the end of the financial year. The net profit and net loss, it is the actual amount what the farmer has gained and what the farmer has lost. Then to compare the income or the loss with the previous year. So it is very much essential that what is the growth of business is going on. Third, the control on the expenses. If the farmer finds that my expenses are very high, so he can control the expenses. Then it is also required for preparation of the balance sheet, and then for other government oriented rules from time to time, like income tax purpose. So for all these purposes, we need the profit and loss account to be prepared at the end of the financial year. Then what are the different components of the profit and loss account? So it has two basic components. First is the indirect expenses and the another is the gross profit. So indirect expenses are those expenses which are in general associated with the selling of the product. So for example, if we are selling the milk at the dairy farm, the expenses occurring during its transportation, expenses during occurring its packaging or the electricity, whatever it may be. So that are kind of the indirect expenses. Then the various examples of the indirect expenses can be. So number one, it is the office and administration expenses. So in these expenses, the salary of the staff, the salary and wages of the contract and the daily pays, the rent paid by the owner for its farm, and the insurance rates, printing and stationery which can be used in the offices, postage, telephone expenses, even the audit fee. Another one could be the selling and distribution expenses. So in this, it can be the advertisement expenses. So today, as we know, that advertisement is very much required to sell the product. Then showroom rent, godown rent, lighting, traveling expenses, and commission on even sale of your product. Then number three, the financial expenses. So financial expenses may be in the term of the interest on the loan, and then is the discount whatever he gives on its product. Then the repair and maintenance expenses. So there could be many repair and maintenance expenses at the farm. So these could be repairing of the furniture, building, machinery, and even the depreciation of all these. So these indirect expenses, these come on the debit side, and the gross profit and the other any profit which is associated with the business activity or the livestock farm, that we add on the credit side. Then the further the representation of profit and loss account and how it can be prepared. So first this account is having 4 basic columns. So first is the particulars under which the expenses are made. Then is the debit amount, what is the amount for that expenses. Then is the by trading account, that is the gross profit, and then the credit amount. So suppose it is the salaries around 24,000, the expenses on lighting is around 480 rupees, on rent paid it is 2,000, traveling it is 1,000, commission 500, depreciation 1,500, printing and stationery it is 1,200. So all these are the indirect expenses and it is on the debit side. And then on the credit side, it is the gross profit which comes out from the trading account or any other income gain which is associated with the business. So it means that on the expenses side, it is the 30,680 rupees, and on the gain side, it is the 50,800 rupees. So the less amount or the net profit, it is added to the capital amount so that both these sides they should remain the same. Project preparation in a livestock enterprise. So first, what is a project? It is a time-bound activity with specific purpose or the specific goal. And if a farmer is interested in a dairy farming, so he is to submit a project proposal to a financial institute for the loan purpose, for its approval, because the finance requirement is the basic step or it is the basic requirement to start an activity or the business or a enterprise. What could be the basic steps in the preparation of a project running for 1 year having the 10 dairy animals? So first we have to give some assumptions. So these assumptions are the prior considerations to be mentioned or declared before the actual activity is to be carried out or started. So in this case, the assumptions we may take that the land which is required to start a dairy farming for green fodder, cultivation, for shed construction, for gobar gas plant or for tubal, it will be of the owner or the livestock farmer, and the family labor, it could be another assumption that whether 1 or 2 family members can be there to help the main livestock farmer. In the next slides, so whatever the prices are mentioned, so these are just hypothetical prices, not the actual prices, just to make the understand. So first is the fixed cost is that amount which is used to create the assets or to start a activity, and these will not change with the time. So for example, in this project which is for the 10 dairy animals or 10 dairy cows, we need the construction of the shed. So we have assumed that for the cost of construction for cow shed, calf shed, feed store or labor room, any, so we assume that it could be 3,50,000. Then we also need the equipment and machinery, so it could be of the rupees 50,000. Then if a person or the dairy farmer is to start with the dairy animals, so just as a assuming charge is 40,000 per animal, so it is around 4 lakh of rupees. So total, if we say the fixed cost comes out to be the 8 lakh rupees. So then the availability of the finance. So first is the margin money. So if a total project cost comes out to be 8 lakh, so at the rate of 20%, 1,60,000 rupees comes as a margin money, means which should be available or which is to be contributed by the owner himself. Then the loan amount from the bank, it is the 80% of the total cost, that is around 6,40,000, so that the project cost comes at 8 lakh of rupees. Depreciation per year. So in this we can add the depreciation values as like the on dairy animals, which we have obtained at the cost of rupees 4 lakh, so 10% depreciation on each dairy animal, so it comes out to be 40,000 rupees. On shed, it is assumed that around 5% depreciation per year could be there, so it is 17,500 rupees. And on machinery and equipment, it is at the rate of 10% in that year, so it is 5,000. Then is the working cost. So working cost is that cost which is required to running a dairy farm. So in that there could be a cost of feed per animal per year. So if it is at the rate of 3,000 per animal per month, so in a year for 10 dairy animals, it is 3,60,000 per year on the feed cost. Then we may require the labor at our farm. So at the rate of 5,000 per month, this cost is also included, 60,000 per year. Then on the medicine or the veterinary help or the treatment, so for 10 animals, it could be 50,000 per year. The non-electricity charges at the farm, so around 72,000 per year at the rate of 6,000 per month. Then the other kind of miscellaneous expenses, so that is around 42,000 per year. So total working cost, which is also known as the running cost in the dairy farm, so which may vary with the number of animals and electricity consumption. Then what could be the total expenses? So it is the sum total of depreciation plus bank expenses plus the working cost. So the total working expenses can be depreciation plus bank plus working cost. So 62,500 rupees as a depreciation, as we have calculated earlier. 2,04,800 rupees as bank expenses or in the form of installment or interest, and 5,84,000 as working cost on feed, electricity, labor, like all these things. So it is 8,51,300 rupees. So now the time comes for generation of revenue. So what could be the different sources? So I have just mentioned a few sources from which the major revenue may come. So the total milk production at the rate of 4,050 liters per cow. For 10 cows, it is 40,500 liters of milk per year is there. Then the selling price of milk, if it is at the rate of 20 rupees per liter, so 40,500 multiplied by 25 liters, it comes out to be 10,12,500 per year. Then the selling price of the manure, which is at the farm, so we may earn also from that, it is the 20,000 per year. Then the selling price of calves in that year, so it could be the 50,000 per year. So this is a revenue generated from the farm. So now we have to calculate the income. So what is the income generation for in that particular year for which we have make the project. So the revenue generated, that is the 11 lakh 23,000 minus 8 lakh 51,300 rupees, it comes out to be 2 lakh 71,700 rupees.
Now, we will discuss about balance sheet. Balance sheet is also known as net worth statement, as it tells the net worth of a business. A balance sheet is a summary statement of all the assets and liabilities of a business at a given point of time. It is a statement of financial position of a business which is prepared for a particular date and not for a period. Generally, a balance sheet has two sides, assets and liabilities. The assets are listed on the left hand side and liabilities are listed on the right hand side. Net worth of the business, which is also known as equity, it is listed on bottom of right hand side under liabilities. Generally, the left hand side values are equal or balances the right hand side values, and hence this statement is called as balance sheet. Balance sheet is generally prepared at the end of financial year. If assets are more than liabilities, business is solvent, and if liabilities are more than assets, business is insolvent. And the solvency of the business means that how a business meets its long-term financial goals. So before making balance sheet, one should know about the following terms. Current assets. Current assets are those which are used within an year or within one production cycle. For example, cash at hand or in bank, inventory, etc. Medium-term assets are used within 1 to 5 years. For example, equipment. Fixed assets are those which are used in more than 5 years. For example, land, buildings. Current liabilities, these are those liabilities which needs to be repaid within a production cycle or within a financial year. For example, taxes payable, borrowings, etc. Working or medium-term liabilities needs to be repaid within 1 to 5 years. For example, short-term loans or bank loans. Deferred or long-term liabilities needs to be repaid in more than 5 years. For example, long-term loans. And net worth or the equity, it is assets minus liability at a present point of time. Now we'll take an example how to develop a balance sheet. For example, a dairy processing entrepreneur has a land of 2 acres worth rupees 5 lakh, which is the fixed asset. He has a khoa producing unit worth rupees 50,000, which is working asset or medium term asset. In his current account in SBI Bank, he has 25,000 as current asset. Taxes payable for the current financial year is rupees 20,000, which is current liability. Wealth tax is 5,000, which is current liability. He borrowed rupees 10,000 from his neighbor, which is current liability. He has inventory worth rupees 30,000, which is current asset. He has an ice cream mix unit worth rupees 1 lakh, which is working asset. He has bank deposit of rupees 25,000, which is current asset. He bought loan of rupees 1 lakh, which is medium term liability from bank, which must be paid within 3 years. He also borrowed loan for land development for 10 years of rupees 2 lakhs, which is long term liability. Now let's prepare the balance sheet. For your convenience, all the assets and liabilities are listed in this particular example. Now let's develop the balance sheet for this example. On the top, the heading should be balance sheet of dairy processing enterprise as on 31st March 2021. On left hand side, assets and the value will be listed. On right hand side, liabilities and their values should be written. Now under current assets, current account balance, inventories, bank deposit will come, and the total current asset will sum to 80,000 rupees. Under working or medium term assets, khoa producing unit, ice cream unit will be written, and the total working assets, it will sum up to 1.5 lakh rupees. Under fixed assets, only land will come, and the total fixed assets will be 5 lakh rupees. So the sum of all the assets, it will become 7 lakh 30,000 rupees. So as far as liabilities are concerned, under current liabilities, taxes payable, wealth tax and neighbor borrowing will come, and the total current liabilities will sum up to 35,000 rupees. Medium term liabilities consist of bank loan of rupees 1 lakh, and under long term liabilities, land development loan will come, which sums up to 2 lakhs. So the total liabilities, it become 3 lakh 35,000. Now talking about net worth or equity of this particular business, total assets minus total liabilities will give us the net worth, and which will be 7,30,000 minus 3,35,000, summing up to 3,95,000 rupees. So this is the example how balance sheet for a dairy processing enterprise or a dairy unit or any other enterprise pertaining to livestock is developed.
Break-even analysis, where an organization is neither making money or nor losing money, but all the costs have been covered. Break-even analysis is useful in studying the relationship between the variable cost, fixed cost, and revenue. Break-even point analysis is used to determine the number of units or revenue needed to cover the total cost, that is the fixed and the variable cost. The analysis is based on the relationship profit is equal to revenue minus total cost. At break-even, there is no profit or no loss. Here, revenue is equal to total cost. There are two types of cost, fixed cost and the variable cost. Fixed cost includes costs such as building, insurance, fixed overhead, rent of land, etc. These costs are fixed irrespective of the production. In case of no production also, the cost must be incurred. Variable cost. Variable costs are the costs that will change in direct relation to the production volume. These costs include cost of raw material, packaging cost, fuel, and other costs that are directly related to the production. Third is the total cost. This is simply the sum of fixed and the variable cost. So total cost is equal to fixed cost plus variable cost. Now we will do an exercise on break-even chart. Question: in an enterprise, fixed cost of production is rupees 20,000. Variable cost of production is rupees 5 per unit. Sale price of 1 unit is rupees 25. We have to find break-even quantity and break-even revenue. Break-even output or quantity means the units required to reach the break-even point. So it is equal to fixed cost divided by the difference of selling price and the variable cost of 1 unit. By applying this formula, we will get 20,000 divided by 25 minus 5, that is 1000 units. It means 1000 units should be produced to reach the break-even. Break-even revenue meaning the revenue required to reach the break-even point. So it is equal to break-even output multiplied by selling price per unit. It will be 1000 multiplied by 25 means rupees 25,000. The total cost of production at break-even. So it will be equal to cost of production per unit multiplied by break-even output, and we will add the fixed cost. By applying the values, the answer will be rupees 25,000. Means the total cost of production at break-even is rupees 25,000. We will see that at break-even, the total cost of production and break-even revenue both will be same. Hence, at break-even, revenue is equal to total cost. Here is the tabular chart indicating cost and revenue in relation to the number of units produced. The cost will remain same what may be the number of units produced, whereas all other values will depend upon the production. We can see in case number 1, the number of units produced are 0. The fixed cost, that is 20,000, it will remain the same. Since nothing is being produced, the variable cost will be 0. The total cost is equal to variable cost plus fixed cost. Revenue, nothing is being produced, the revenue will be 0. Then the profit. Profit is equal to revenue minus total cost. Here, no revenue is being generated, but cost is 20,000. Here the enterprise will get the loss of rupees 20,000. As the number of units are increasing, the loss will decrease. We can see 1000 is the break-even output. At this output, the total cost is equal to the revenue generated. So here there will be no profit or loss. So above this break-even output, there will be profit. So, as the number of units are increasing, the profit will increase. On the basis of this tabular chart, we will prepare a break-even chart. Here, we can see variable cost, fixed cost, total cost, and the revenue. The first line, variable cost, we can see that when no unit is being produced, here 0 unit is being produced, the variable cost will also be 0. As the number of units produced are increasing, the variable cost is also as the number of units being produced, as the number of units are increasing, the variable cost will also increase. Second line is the revenue. So revenue will also increase with the increase in number of units produced. Then is the fixed cost. Fixed cost is independent of the number of units produced, so it will remain same. Even when no unit is being produced, fixed cost is 2000. Then is the total cost. So total cost is simply the sum of fixed and the variable cost. So break-even point. Break-even point is the point where total cost is equal to the total revenue, means where these two lines of total cost and total revenue intersect. This is the break-even point. So we can see that at break-even point, the output is 1000 units and the break-even revenue is 25,000. Means below this there will be loss and above this point there will be profit, and at this point there will be no profit or no loss. Now a study question for you to solve. You will solve break-even analysis numerical. Here the selling price of dairy product is rupees 20 per unit, variable cost is rupees 15 per unit, and total fixed cost per day is rupees 4000, and average sale is 1400 units per day. Here you have to calculate break-even point, break-even revenue, margin of safety, and percentage margin of safety. Also, you have to solve the break-even analysis numerical with different level of production. Thank you.
So the next topic in the row is net present worth, BCR, benefit cost ratio, and internal rate of return. So these are the discounted measure of project financial viability. How we can assess the project financial viability or profitability? There are two types of measure through which we can measure the project worth, that is undiscounted measure and discounted measure. The basic difference between these two measure, discounted measure and undiscounted measure, is that the discounted measure take the time value of money into consideration, while undiscounted measure they do not take the time value of money into consideration. So we will discuss the discounted measure of project financial viability. So which will cover the time value of money. Now coming to what is the time value of money. So here we take one hypothetical example. So suppose two conditions. In first condition, suppose you have rupees 500 in your hand right now, and another condition, after 1 year, again suppose you have rupees 500 in your hand. So two situation. In one situation you have rupees 500 in your hand right now, and another situation you have rupees 500 in future. So which is better? The obvious answer is the money in hand right now is better than the money in hand in future, because the purchasing power of money fall down with the passage of time. So you cannot purchase the same thing at the same cost in the future. So this is the time value of money. Now coming to discounting. What is discounting? So it is the converting of future value of cash to the present value of cash. So all the discounted measures, whatever money we received in the future, are discounted back to their present value. So now coming to what is present value. So we can calculate the present value of the future cash flow by using this formula. Future value is to 1 over 1 plus r raised to the power n, where r is the discount rate and n is the number of year. So we can calculate the present value of any future cash flow by using this formula. Now coming to net present worth, also known as net present value. So it is the difference between the present value of cash inflow and the present value of cash outflow. In simple word, it is the difference between the present benefit and present cost. If net present worth is positive, it means project is financially viable. If net present worth is negative, it means project is not financially viable. So let's take one example. Suppose a project has following cash flow over 4 year of time period and discount rate is 12% for this project. You need to calculate the net present worth for this example. So given is the number of year, initial cost is in the present day. So in this column we have mentioned 0 year because the cost occurs on the day 1. Then in the third column we have mentioned the cash inflow for the next subsequent 4 year. So we need to convert this future cash inflow into the present value by using the discount factor, and which can be calculated by using the formula given in the previous slides. So we can calculate the present value of all the future money. So the present value of the cost occurred remains same. That is, if in this table it is 5 lakh only. So the present value of all the cash inflow we can calculate it. So all the future cash flow will be reduced to the present value by multiplying them with a discount factor. Then we total all the cash inflow. It comes out to be 5,29,337. So then we take the difference between the cash inflow and the cash outflow, that is benefit and cost. So difference comes out to be 29,337. So this is the net present worth of this project, and this is the positive value, so it indicates a good sign. So project is viable. Next is benefit cost ratio, also known as BC ratio or BCR. It is the ratio of benefit derived from the any type of project or farming to the total cost occurred. It is also known as profitability index. If the BCR comes out to be more than 1, then project is supposed to be economical viable. If BCR is 1, then project is supposed to be at break-even point, that is no profit, no loss. And if BCR is less than 1, then project is supposed to be not viable. So take the same example as we discussed in the net present worth. So here we have to take the ratio of the benefit derived over the cost occurred. So see in the last column, so BCR comes out to be 1.06, so it's more than 1. So we can assume that this project is financially viable. Now coming to internal rate of return. Contrary to previous two terminology, so IRR, internal rate of return, represent the discount rate at which the net present worth equal to 0. So at the IRR, the present value of expected cash flow equal to initial cost or initial outflow of money. So generally higher IRR is preferred. So IRR is calculated by hit and trial method. First, an arbitrary discount rate is assumed and corresponding net present worth value is calculated. If net present worth value comes out to be positive, a still higher discount rate is assumed. If again net present worth value comes positive, a still higher discount rate is assumed. This process is continuous till the net present worth value turn negative. The discount rate at which the net present worth value turns negative become the higher discount rate, and the previous discount rate at which the net present worth value was still positive become the lower discount rate. So by using these two values, we can calculate the internal rate of return by using the formula you are seeing on the screen. So where L is the lower discount rate, H is the higher discount rate, NL is the net present worth at lower rate, and NH is net present worth at the higher rate. We can take one example. So the first example is the same as we discussed in the previous two terminology, that is net present worth and benefit cost ratio. So same example, here we calculate the net present worth with the discount rate of 12%. So here the net present worth comes out to be 29,337. So it is a positive value. So we need to assume a bit more higher discount rate. So in the second example, we assume higher discount rate at the rate of 15%. Then we do all the calculation on a similar way to calculate the net present worth. So see in the last column, now the net present worth comes out to be a negative figure, that is minus 2,295. So now using these two figures, one of positive net present worth and one negative net present worth, we can calculate IRR. By putting all the figure in the formula, we can calculate IR. So in this example, the IR figure comes out to be 14.78%. So at this percentage, the net present worth equal to 0. So these are the three measure through which we can measure the project worth, whether the project are financially viable or not. Thank you.
To watch more educational videos on veterinary and animal sciences, subscribe the channel and please touch the bell icon. Guru Angad Dev Veterinary and Animal Sciences University, Ludhiana on YouTube.